G'day and welcome to the Fox and the Hedgehog. My name's Alastair King. I am a commercial and residential mortgage broker from Glenclair Financial.
I'm James Beatar. Focuses around residential real estate investment and mortgage broking, and we have been gathering to talk about a whole bunch of meaty topics around that sort of sector. And today we thought we'd specifically talk about the residential aspect of mortgage broking and how that links to investment portfolios.
Every single person hears as they start to think about saving, investing, and allocating capital, where is the best place to allocate your wealth? Very commonplace that a lot of families have built wealth over generations have been through property. A key component of that is where do they get their debt from? How do they source their debt or get their capital? Many families came to Australia, immigrated, and they bought property, and over time it's just compounded at a really steady rate. So we're really going to delve into that today. I'm quite excited. We're going to focus in on a couple of key topics. One, thinking about strategy with how to utilizing leverage. And the second thing we were going to talk about, James, was
in linking back to the mortgage structure, those couple of questions, exactly what you talked about with strategy. What are some of the key variables in setting up a mortgage that can impact how you grow your portfolio? So interest rates aren't the only important factor, and what other facets of a loan can help you or potentially hinder you? And then what kind of role does the mortgage play overall with setting up your portfolio and putting you in a position to grow that over time?
Also thinking about how much do you want to be paying for leverage? We were just discussing previously the ability to gear up to 100% of an asset. You can still do that, but just the dangers of doing that and the pros as well, and just the ways to think about how to do that effectively without finding yourself in trouble.
That first holistic question of what kind of role does your mortgage play for investors when setting up your portfolio? So how do you see it coming into play? Where is its impact most felt in setting up a real estate investment portfolio?
The reality is that in order to purchase an asset, any asset, you need the capital. You either get that from equity, saved up, or you found friends, family, fools, the 3 Fs, who've provided that equity. Often there's a real cost to equity, and equity is actually a lot more expensive. And the other source of capital is debt. That is utilizing leverage as much as possible. Real estate as a class is very unique in that you are able to gear it up a lot more than any other asset class. I will say safely than any other asset class. And what I mean by that, yes, you can gear up shares or equity to the same degree, but due to market movements on a daily basis, if your portfolio suddenly is impacted in any way, shape or form, you have a margin
call. There's a high exposure, yeah.
The same concept still applies for real estate in that if your asset decreases in value, and definitely real estate does decrease in value. I've got a couple of horror stories of clients who bought in the Gold Coast in the year 2000, and one of them bought for $2 million in the year 2000. They had to sell that asset in 2012 for $800,000. So they had a $1.2 million write-off as an example. So, real estate is not a lay down misere as an asset class. And within that, and I try to use these words of asset class because it is an asset class. Historically over time, real estate has increased and compounds at about 8%.
And I think it's also important to note that largely we're referring to the Australian market at the moment. There are certainly other connotations and other sorts of trends and fluctuations in other international markets. So this is largely geared around Australia. Is that fair to say?
Yeah, correct. Just for context, this is entirely the Australian market. The 8% compounding is historical long-term average.
Mm-hmm.
You'll see some years this property went up by 10%.
And that can happen in a very short amount of time with little growth over a large amount of time. I remember one of my assets did relatively little for about 8 years. And then within the next 2 to 3 years, it did most of its growing to the point where it over doubled in that short time frame. So it is important to note that is a holistic viewpoint over an extended period of time. You won't see it go up numerically by 8% every year.
No. But generally that 10 to 15 years, you should see it double in value. And the beauty of using leverage is exactly that, which is and we'll take a very simple example. I've got $1 million property. I take out $1 million of debt. If that doubles in 10 years, I've got a $2 million asset and my debt's still $1 million. And so now I've just made myself $1 million and I haven't had to put any capital in it. Theoretically, that plays out. I mean, in reality, though, that you've had to service $1 million debt last 10 years, 15 years, whatever time it takes to double. And therefore, the actual asset itself, being the property, is so important. And we're not including all the fees attached, stamp duty, strata if you have it, legal. So often even though the asset when you purchase it might be $1 million, all up costs are 1.1, and you've had to pay $1.1 million, so that's your liability, and the asset's worth 1. So immediately on that $1 million purchase, technically you've
$100,000 write-off.
$100,000 write-off if you sell it tomorrow. So how we think about leverage and using leverage effectively is very important. And the way to most effectively use it, in my opinion, is to have a very long-term focus.
Yeah, and I think it stems nicely into that question of what impact can a mortgage have on your strategy for setting up an investment portfolio. And as you said, having that long-term vision allows you to take into consideration not just something more immediate like the interest rate or variable interest rate at that given time, but what other facets of that mortgage can you utilize or leverage to make sure you're setting yourself up for future growth?
So often in mortgage, you will have the ability to either put in an offset. If you do, it costs a little bit more.
And I think it's important to sort of clarify what some of these features mean as well.
Yeah, so when we put in an offset account, all an offset is that if you place any money into an offset account, that offsets the interest payable on the loan. So and the way interest is calculated is it's calculated daily and capitalized monthly or paid monthly. So as an example, if I have $1 million mortgage and I've got $100,000 in the offset, I am only paying interest on $900,000 for that day, and that'll be paid at the end of the month.
And I think an important feature is, or an important distinction is, the offset account still acts like a regular bank account. So talking about the offset, I think one of the key distinctions with an offset account rather than paying down the home loan, which in effect has a similar impact. As you just described, if you have a set amount of money in the offset, the loan amount is treated as if that were deducted from the overall loan amount. But with an offset account, you can actually pull money out of that or add money in a lot more freely than actually paying down or extracting money from the home loan account.
Correct. Using it as a working capital line to some degree. And definitely when you start thinking about strategy around loans, this is very important, because if you are often with a home loan, which is non-deductible debt traditionally, there are some strategies out there where you can look to do deductible debt for a home loan. Non-deductible debt is the most expensive form of debt, and therefore reducing your home loan as quickly as possible should be your primary priority.
And this is your primary place of residence.
And this is your primary place of residence. It changes slightly when you start talking about an investment property, because investment properties, you want to treat it as an investment and structure it accordingly. Whereas when you're talking about your home and home loan, non-deductible debt, you need to think about the flow of cash. So the flow of cash is from your business or let's take it if you're a small business owner. It takes you perform a service or sell a product or goods, you receive cash. You will then need to pay tax on that cash, whatever the profit is. That's where you've had one lot of tax paid. You then distribute it to you as a shareholder or as an employee. If it's an employee, it will be pre-tax, but even still, let's say you've already paid tax on that, you distribute it to you as an individual, you will then have to pay tax on that again. I mean, there are franking credits, etc. But you then have to pay tax at your marginal tax rate, and then you pay your mortgage off. So that's what I talk about when I say it's the worst kind of debt. It's this bad debt, but it's a very necessary evil, because it's where we get our capital from to buy these assets, buy where we live, otherwise we're renting.
And one of the benefits of that, of course, is if you were to sell that home, you are not exposed to capital
gains
gains
tax.
tax.
Correct. So there are definite advantages, but more what I'm saying is that the sooner you can pay down that non-deductible debt, the better. And then, in fact, you can use that property value to gear up. But just while we're talking strategy, because it's important, the worst kind of debt is right at the bottom after we've paid 2 lots of tax. If we can somehow shift it where we pay interest prior to paying any sort of tax, you actually decrease the effective interest rate substantially.
Mm-hmm.
And the way to calculate that is your interest rate multiplied by your tax rate. So, for a lot of individuals, particularly wealthy medicos, barristers, we're in Macquarie Street surrounded by barristers, that's where they have to operate in their individual names, and so they all pay top marginal tax bracket. So the way to think about it is you multiply the actual interest rate by your tax rate, 47%, and that's the actual effective rate. So whilst your headline rate on, say, business lending might be a bit higher, the effective rate is actually a lot lower than home lending. So yeah, you've just got to start to think about these things. And if we then move on to how do we build wealth over generations, it's using that structure effectively. So that is,
or even within your own lifetime as you're increasing your portfolio, ideally.
Correct. And so if we look at each individual, and you say, okay, great, I'm looking to buy an investment property, you need to start thinking about these tools, which, do I actually want an offset on this investment, or actually is a better strategy to use that first example we spoke about, which is in 10 years' time, I don't really care if that loan's reduced by my standard 30-year term. In fact, I would rather it to have an interest-only period of 10 years, because any principal reduction is cash from my pocket. Whereas if we have a 5-year interest-only period, which is often the maximum banks will allow, ideally a 10-year interest-only period, I've paid interest, but I've actually got a tax deduction as well from that. And this is general advice only, and definitely speak to your financial advisor. But often a really effective strategy, if you're very comfortable with the asset, is to seek interest only for as long as you can get it. And not only is it the property value is going up, and the reason the property value is going up is because the income on the asset is going up. That is often rent will increase by CPI at a minimum, and really the value of the asset is the value of all future repayments into perpetuity. So and that's what a really good definition of value is, which is Ben Graham's, Warren Buffett's great mentor. That was the definition he used, and I actually love that the most. In other words, if I said to you, oh, what's the value of this asset? You say, well, it's the market. And I'll say, well, actually, I challenge that slightly. I actually believe it's the value of the income you can receive on that asset from now into perpetuity, with a degree of margin of safety, that is using a discount rate for your cost of capital.